Welcome to the Money Business Podcast. I'm Neal Regino.
I'm Brian Weyman.
Today we're going to talk about life insurance.
Life insurance.
Really exciting topic. You know, we hear about this all the time, so
But get a lot of questions about it.
get a lot of questions. Do I have the right kind? Am I paying too much? How do I get the cheapest? Why should I have permanent?
What kind of insurance do I have?
Yeah. So let's start with the basics. We're really going to just talk about the three main categories, potentially a fourth, but you want to get started and just go through the basics of insurance?
Well, yeah, sure. So, I mean, more times than not, people can. Well, first of all, there's two types in the sense of term insurance or permanent insurance, right? And everybody thinks permanent insurance is always whole life. They always use the word, "Oh, I think I have whole life." It's not always whole life, but let's start with term, right? What is term? The way I describe it to most people is, term insurance is almost like renting something, right? It's like renting an apartment, renting something. You're going to pay a premium for the amount of time that the term is set up for. You bought $1 million of coverage in a 20-year term. Most people think that means the term comes to an end in 20 years. It doesn't, which I'm talking to you like you know. You don't know. You don't know this stuff. But basically, what's happening is you bought a term policy. Could be a 10-year term, 15-year term, 20-year term, whatever you're buying, whatever the length is. At the end of that 20 years, that just means that the fixed premium that you've been paying for 20 years is now going to start to increase. More times than not, people don't keep those policies because the increases get so high that they don't want to pay them anymore, because you literally could go from $100 a month to $1,000 a month at some point, right? If you just keep letting it go. But to me, I always explain it as term is just for a period of time and for a certain reason.
Yep.
So,
And that, everybody thinks of life insurance is just death benefit. When you're buying term, for the most part, it really is just the death benefit that you're buying. And it's to cover a need that you don't want to spend a lot of money on, or maybe don't have the ability to, or fits into your situation, and that's what you should buy. But ultimately, there's an end in sight, and there's really only one way to access it, unless it has living benefits on it. But ultimately, it's if you die, family, beneficiary, whoever is supposed to have insurable interest is going to receive that.
right.
But
I do like, though, that the term products that have living benefits. So let's not gloss over that they don't.
yeah,
Because even though typically you're not going to use those living benefits, I've had stuff happen to me. My wife's had to my family friend. I'm older than you, so you'll see. But as you get older, you start to see these things happen to people: heart attacks, cancer, stroke, things like that. Where if they had that in place, it could really help them financially to use it,
well,
especially if it's only temporary insurance to begin with.
yeah, we can pause right there and go off on a tangent about ABRs, or accelerated riders, which a lot of companies have. So I personally had experiences with clients. You say I'm not that old yet, but I had a client who was
I was
much
giving you props.
younger than me, paid into a term policy for 2 months, was diagnosed with cancer, and after 90 days of the diagnosis, she was able to get a substantial payout on a term policy. So um, I've seen where it actually really helps people out. I've also had somebody where a child, they bought a policy that they were using for accumulation on and death benefit on a child, and he was diagnosed with a rare cancer, and they called me to change their contributions around. And I asked them what was going on, and they told me, and they said, we can't really afford what we've been doing because we're dealing with medical bills. And I said, well, you have this policy, you can access this if depending on what it was. And they ended up getting a substantial payout. The child is fine, and the first client I mentioned is also fine now. But they were able to get this large benefit that significantly helped their overall financial picture. So having living benefits is definitely
No, I don't recommend anybody have a policy without living benefits.
yeah,
On it.
and it's an added bonus to something that you're using anyway for death benefit. But
Right.
so term, you think about it as cheapest option, gives you death benefit for a certain period of time. Maybe it's a mortgage, you just want something to pay off and you line it up with the mortgage. Maybe it's replacing income while you have kids that are living at home and you line it up with what you think will be their move out date. But that's really the purpose, is just give you protection for the lowest cost.
Right. So term is renting. So now let's talk about the other way we describe it as when you buy permanent insurance. It's more like you're buying a house
Yep.
versus renting an apartment, right? So let's talk a little bit about the differences between universal life and whole life. Where do you start when you're trying to describe the differences?
So I definitely talk about whole life. Whole life's the oldest policy in our industry. What whole life is you pay in, you have a contract premium, and part of it goes towards the expense of the insurance, part of it goes towards cash accumulation. The growth of the account is determined by a insurance company's ability to pay a dividend. So if a company has a good year, then they're going to split their profits up among their policyholders, uh, and there are some great companies out there. I'll just mention New York Life, Mass Mutual, Northwest Mutual, National Life. They've all been around for over 150, 170 years, depending on which company. Never missed a dividend, had really good growth, relative growth over time in those policies, and it's a little bit safe as far as the making sure you're going to get some kind of interest on there as a dividend, and that over time it will grow steadily. Um, the all of the dependence is on one company when you're buying whole life. So if a company makes a bad financial decision, even if they're A rated, it could potentially impact that dividend. And I won't name any names, but there are companies in the last 10 years that this has happened to.
And to be clear, it affects the dividend. It doesn't affect the insured's
Correct.
death benefit or the insurability. It just doesn't give any credit to their cash value at that point.
Correct.
Right. Make that clear.
But for the right situation, it's a great product to have, a great solution to potentially get your money back that you put in. So at some point, let's say you paid $100,000 in premiums. Just for instance, the account's now cash value is $110,000. Well, you made your money back. The insurance costs you nothing. So at some point, that is the idea that if it's designed correctly, that will happen. Um, so yeah, no qualms with whole life if for the right person and the right situation, and that's the basics on there. But again, comes with a death benefit, comes with another asset as cash accumulation, and can be built with those accelerator riders we talked about. So there are a lot of ways to build a policy that's right for your situation.
Right. Now, and then you have index universal life as one of the universal lives. There's, guaranteed ULs, survivorship policies, but index universal life is a popular one. Let's talk a little bit about that. I always, when I get the question of, well, what's the big difference between index universal life and whole life? My first thing is obviously the crediting, right? Because you just mentioned whole life's credited by the dividend from the insurance company, where index universal life, we're tying the gain of that cash value savings account to an index in the stock market, S&P 500, whatever, right? But I kind of explain it to them as a more flexible product. The other reason I think, in my opinion, is why more people tend to fall. They don't want term, but they don't want to spend a whole life because that's the most expensive. They fall in the middle with index universal life because they can control the premiums. The premiums are lower, especially in the beginning, right? But they can go up over time. But the idea really is that it's kind of like they're getting the best of both worlds. They're not paying the highest price. They're getting all the coverage they need, but it's not going to run out like term. So how do you kind of describe the differences?
Yeah, well, number one, I don't really want to compare pricing on whole life versus index universal life. We do say term is the cheapest, but then it depends on the company, depends on the rating. A whole life and index universal life depends how they're designed, depends how you're funding it, if one's going to be more expensive than the other. So, it just needs to be designed for your situation.
The payments are flexible, though.
Correct.
Right.
Yeah. So I apologize. Yes, the payments are flexible. So you're taking the onus off of one company, and now you're using an overall index. If you use the S&P 500, now you're using the entire largest 500 company plus in the industry, and whatever it does, if it's up, you're going to make money. If it's down, you don't lose anything except for the expense of the policy. So as long as you make the premium, the policy will stay in force. And your upside potential's higher. And there are other indexes out there that, so in general, if you're using the S&P, you're going to have a cap. There's other indexes without a cap, so maybe the cap's 9%. If that's the cap and the market's up 20, you only make 9. But then you have that downside risk protection, market risk protection as well. So over time, you have a lot more potential to make money.
So let's circle back for a second because, we're talking in terms of, we're talking at a level where we know what we're saying, but sometimes we're glazing over the fact that we get the question of like, what is cash value?
Yeah.
What is that? Well, we're talking about crediting and caps and all these things, but at the end of the day, we need people to understand that as you pay your premium, whether it's a universal life or whole life, as you pay your premium, there's basically, for lack of a better term, a savings account attached to your policy that's your money. And a portion of your premium goes into that bank. So when we're talking in terms of, whole life company dividend, that means whatever amount of money you have in that bank, in your savings account that's attached to your policy that year, that company's paying that dividend as interest on that cash value. In the index universal life, it's coming from like the S&P 500 or whatever index. However, that return comes up to that cap, meaning if the S&P 500 were who you were using to credit your interest on your account, and your cap was 9%, and the S&P 500 went to 12%, you're only making 9. So that's kind of how a cap is. So I just wanted to circle back and kind of bring that down to more minute thing, because sometimes I think we start talking and we know what we're talking about.
Yeah. And
somebody else might not.
I believe the highest dividend in the industry last year on whole life was 6%. So even at 9, you're beating that. Now the risk to an index universal life is that if you have a few down years and you're not making any credit, you're not making money on it, you're not losing, but you're not making anything. If you're in whole life, you'd be receiving that dividend. So I'd say safety of expectation that every year you would receive some kind of payment into the account, some kind of extra interest or dividend. On whole life, it's a little bit safer. On index universal life, you could be in the S&P and from 2000 to 2002 and have a 0% for 3 years. It also does mean you're going to have a bigger chance to make money when the market goes up because you're going to start at a lower period. But yeah, so there's pros and cons to both. Now, if you're building it for another bucket as far as your assets are concerned, it may make sense to have something that has more upside potential, especially for the long run. And then I think it's worth touching on variable universal life. So they're not as common as they used to be, but they do still exist. There are still some benefits and some downsides to it. The big downside is you can lose more money than the other options that we talked about.
Yeah, so to bring it down to basics, the difference on the variable universal life, again, is the crediting, right? It's the same thing as far as death benefit and riders, and you can do all that stuff. But the crediting on your cash savings is coming from actual investments, actual mutual funds that are within a portfolio. It's not coming from a company dividend like whole life or just the overall index like index universal life. It's coming from specific mutual funds that you've selected inside there. So the difference is in the whole life and the index universal life, your cash value can never go down. Variable universal life, it's the same as being in the stock market. It can go up, it can go down.
Yep. And then we don't need to dive in it too much, but the pricing on the expenses can change as well over time, right, depending on how it's designed. So making sure, again, that you're working with somebody that knows your situation and is pointing to what makes the most sense.
Right. So you got two types. You got term and you have a whole permanent, but there's a whole slew of different types of permanent policies out there. So getting the correct one for yourself is going to come down to talking to somebody that knows their way around it.
Yeah. I do want to talk briefly about some other riders on there. So there are companies out there that have death benefit with long-term care riders on them. There are outside of the other ones that we mentioned. That so if long-term care is a concern of yours, then there are specific companies that you can use to, normally for the majority of the time with long-term care, you're going to pay in a premium and you may never get a benefit out of it. Hopefully, you never get a benefit out of it. But if you have it where it's on an insurance policy and it has that rider, there's going to be a death benefit. So at some point, there's going to be something that comes out. The other thing is there's a very limited amount of companies that they all can generate some type of income in retirement if they have cash value. There's a couple of companies out there that have income riders, which means that once it's turned on, you can never outlive that income. And if it's designed correctly, it can potentially be tax free um, and guaranteed for life once it starts. So, again, knowing what makes sense, it could potentially work as a retirement vehicle, as another asset as that you have access to, like another savings account or investment account. It does have the death benefit, could have the accelerated riders on it that can give you more protection because, as we know, the biggest unexpected cost in retirement potentially is long-term care costs, which typically happen after age 80 years old. So having those things to give you some extra layers of protection if retirement's a goal, to really think about how do I protect my wealth in retirement. Um, and then high level, I think that's a pretty good place to talk about it. But there's a lot more that comes with it if we dove deeper in, as far as withdrawal rates and
The tax-free benefit.
yeah, taking loans while you're still younger and
Yeah, you can dive deep, deep, deep
Yep,
into this.
yep.
But at the end of the day, you got two types. One builds cash value, one's temporary insurance. No matter what, the death benefit's tax-free, regardless of what you have. Um, it's just, do you want to rent or do you want to buy? That's really what it
Yep.
comes down to.
and everybody's situation is different, so it's not we're not here to tell you that one is better than the other. We're here to tell you, make sure you do your due diligence, work with somebody who knows in order to figure out what the best one is for your situation, or the right one is for your situation. So appreciate your time.
Thank you for coming. We hope this helps.